Let's now connect with Jim Walker, Managing Director and Founder of Asianomics. Jim, good morning. Always delight to have you back on ET Now. Jim, before I get into India-specific questions, characterize the global picture for us. It appears to me that last year was about dividend, diversification, and hiding in bonds. This week, money managers clearly are chasing growth.
Yes, I suppose that's true to a certain extent, but if you wanted me to characterise the global economy in one word at the moment as far as the markets are concerned, that word would be complacency. It just seems to me that everybody seems to have lost sight of what's actually happening in the global economy. For some reason people seem to believe that Europe has been repaired just because the central bank and governments have managed to get sovereign bond yields down. But if you look actually at the real numbers, you'll find that Europe's deteriorating and contracting even faster now than it was during the whole of 2012. The US is moving forward, that's for sure, but we don't know how much of that move forward is down to Hurricane Sandy and how much in anticipation of the thing that didn't happen, the fiscal cliff. Asia, yes, China is accelerating because it's doing all the wrong things yet again. The 7.9% growth generated by local government spending and another credit binge. These are all, I would say, things that are going in the wrong direction, and markets are just far, far too complacent about 2013.
What is the expectation from the budget at this point in time, Jim, and how do you think that will really set tone, or perhaps not, for the rest of the year?
Well, this is going to be an interesting one because, of course, the budget before an election, and the election obviously is not due until 2014, but in other words, this is the only budget that matters in the run-up to the election because the 2014 budget will be too late. That's usually characterised in India by a whole host of populist measures to try and generate support and then keep the government in power. But of course, if it's populist measures this year, then I'm afraid the Reserve Bank of India won't be playing along. It'll be saying, well, if we don't have a consolidation on the fiscal front, if we don't see some real action to try and control the fiscal deficit, then we won't be cutting interest rates, which is just about the last thing that the Indian government can afford this year. So I think they've actually got to do something sensible in the 2013 budget. They've really got to be seen to be making strides towards fiscal consolidation, and in that way they might then encourage the RBI to cut interest rates. So this is going to be a very interesting budget in India this year, hopefully one that's going to deliver a lot more than it just promises.
And if related to the budget, all eyes will be on what the RBI does with the credit policy. What do you expect?
Well, we don't expect any change in this particular round. The government obviously making announcements last week on fuel subsidies and the number of canisters of gas that people could get at subsidised levels. And effectively we think that the central bank actually signalled after those announcements that it's not enough. It's not enough to take one step forward on subsidies by saying that you might allow price adjustments and then take half a step back by saying but we'll increase the number of subsidised gas canisters that people can get a hold of. That really the government wants its cake and wants to eat it as well. It's not willing to go forward with real fiscal consolidation and real measures that would give the RBI encouragement to start cutting interest rates. So we expect at the end of this month no change in monetary policy.
That's a brave call, Jim, because the consensus call is that Reserve Bank of India will cut rates by at least 25 bips. You're sticking your neck out and making a case that we will not get a rate cut? Yes,
that's right. I realise that's the consensus call, and that's certainly the pressure on the Reserve Bank by the government. But I think the Reserve Bank, I hope the Reserve Bank is made of sterner stuff than really just to be cajoled into cutting interest rates because the government keeps promising to do something but actually doesn't deliver.
Isn't something better than nothing? A year ago nothing was coming, but at least there is some improvement. So look at the bright side rather than looking at glass half empty. Glass could be half full also.
Yeah, well, that's certainly true. But as I say, what we've had so far, what we've had in the last year is the economy has slowed down. Capital goods expenditure and capital goods intentions, which are really the heart of economic growth, have not improved over the course of the last year. The markets have gone way up, but the markets have gone way up because there was $24 billion of foreign money coming flooding into the Indian economy on the back of what Ben Bernanke and various other central bankers did around the world. Just floods of liquidity. The truth of the matter is that the Reserve Bank of India surely shouldn't be expected to cut interest rates on the back of a flood of money from the outside. Actually, you would kind of expect it would be doing the reverse. And given that all we've heard so far from the government is really talk about what it's going to do as regards the fiscal deficit rather than action, again, it's a reason for the Reserve Bank to be on hold rather than to be cutting interest rates.
Jim, so are you making a case that for Indian markets 2013 could be a year of inverted V, which is a good start, and then things could pretty much crash land in the second half of this calendar year?
I'm not sure about crash landing, but I certainly think that markets globally have got way ahead of themselves. And the reason they've got way ahead of themselves is, of course, just because of what central banks have been doing. And you're seeing that particularly in Japan at the moment, where there's promises of loads and loads of money, the equity market's going up, the currency's going down. It's hardly worthwhile being a foreign investor trying to capture the equity market in Japan because you lose it all in the currency. But that's the kind of mood that everybody's been in at the beginning of this year, that the problems were solved last year, whereas in actual fact, I don't think the problems were solved at all. They were papered over. And they were papered over with dollar bills. I think it's going to be much harder this year to paper over the problems again if they don't exist. So, for example, can Mario Draghi save the euro again this year? By saving the euro, or saying that he could do anything in his power to save the euro last year, the euro rallied, risk was on, and everybody was happy. We've got the US presidential election out of the road, we've got the fiscal cliff out of the road, we've got a Japanese government that's just going to spend money hand over fist. So everybody has solved all of the problems, except that if you look at the real economies, those problems haven't been solved. But they can't do the same again this year. So the money flows are going to be much weaker in 2013 than they were in 2012. And I think that's going to give equity markets a really tough ride through the course of the year, unless companies can deliver on corporate earnings.
All right, Jim, many thanks for joining us this morning and giving us your perspective on the macro story in India and across the globe.